We've got a lot to cover in today's Kansas City real estate market update. First, the Federal Reserve just raised interest rates for the last time in 2022. It is shaking up the mortgage industry. Second, all the transaction data in Kansas City from November is finally in. There's some troubling news for home sellers and some good news for home buyers. And finally, if you're in the market to buy a new construction home in Kansas City next year in 2023, it might just be your golden opportunity. Part number one is all about mortgage rates right now. And since March, the Federal Reserve has realized that inflation is a bigger issue than they thought. So they started raising interest rates. At first, it was by 25 basis points. That didn't work, so they moved to 50 basis points, and that didn't do anything, so they stayed at 75. And 75, and 75, and 75. But this Wednesday, they bumped up by just 50 basis points. This is a signal of confidence that the economy's headed in the right direction. Inflation is finally reducing, just barely, but it gives the mortgage industry some confidence to reduce mortgage rates. And that's having a profound impact on the real estate market. According to HousingWire.com, the Mortgage Bankers Association predicts rates to stabilize around 5.2% in 2023. That's a sharp contrast from what all of the predictions were back in October and November when rates were at 7%. A 5.2% stabilized mortgage rate would offer buyers a lot more affordability. Now they have less of a monthly payment every single month, so all of those home buyers who are waiting on the sidelines for exactly this, well, now it might be game time. This week, mortgage rates were set around 6.75, but that was before the rate hike announcement, which was less severe than we've seen in the past few months, so you should expect to see some downward pressure on mortgage rates, and as a result, mortgage applications have increased quite a bit. Hey, if you find this helpful or you're interested in more Kansas City real estate information, property tours, informational videos, and market updates, hit the like button and subscribe. I do these market updates every single week, so you stay in the know and you're on top of everything happening in the Kansas City real estate market. Part number two is all about the Kansas City real estate market stats from November, because all the transactions in November have just closed. So we'll take a look at month-to-month trends, and then we'll take a look at year over year, where we're at this year versus where we were at last year. The first thing that I want to point out is the percent of asking price received. Last 2 years, sellers were basically having buyers on their hands and knees, waiving inspections, covering the appraisal gap, not getting any credit. That has all come to an end. 4 months in a row, starting in August, that has declined every single month, and it most likely will continue to decline as the rate of price growth continues to slow. Prices will still grow, it's just they won't grow as quickly. So sellers will not be able to list their home for $10,000, $20,000, $50,000 in the last sold home in the area. But sellers are having to offer credits. They're having to let buyers do inspections, and the appraisal will actually matter and determine how much a credit a seller gives the buyer, etc. moving forward. Also, sellers are doing more work up front before they list their property. They're doing all the repairs, the updates, etc. They would generate them more value and help them sell their home quickly. So if you're thinking of selling, this is something where you want to invest some time and some money so that you can differentiate yourself from all the other homes that are not up with today's market conditions. Now, the second thing that I want to point out, sales price right now is kind of a wash. Nobody's buying because the winter and the holidays have come, and the only people buying and selling right now are super serious. But you'll notice that there's a little variance in the average sales price. That's not a big deal unless we see a long-term trend downwards or upwards. This really doesn't matter. It's just seasonal changes, and it's kind of just a wash. Lastly, the days on market has almost doubled since October. It's taking longer to sell homes. Buyers are being more patient. They're looking at their options more thoroughly. And as a result, if you're selling your home, you're going to have to compete. And the reason that this is the case is because of two. One is the holiday factor. It's cold outside and everybody's spending their time with their family. Two is the mortgage rates. Mortgage rates in November, at least, were pretty high. They hit around 7%. Mortgage rates, of course, have decreased, as we discussed earlier, but they're still weighing on buyers. And as a result, many buyers are waiting until the spring in order to make a final decision. So the last noteworthy part of the month-to-month changes is the closed and pending sales, and you can see that they are down, not by a staggering amount, but a good percent, and that's mostly due to the mortgage rates, I think, or they're falling out of contract because there are more inspections. The appraisal actually matters, and that has a big impact because there have been none of those over the past couple years. Now, let's move to the year-over-year predictions. I have said in the month-to-month that a lot of that is just due to the holidays. Less people are in the market to buy or sell a home. Now, the year-over-year predictions assume that, so everything that you'll see comes down to the one big change between this year and last year, which is mortgage rates. So days on market is up 40%. Buyers are taking their time. Sellers are having to compete. Closed sales are down 30%. And this can't just be due to holiday changes and less people in the market because of the holidays. This is most likely due to mortgage rates. They've had this much of an impact on buyer activity and how many sales are being closed, which is a big one. Not all of that 30% is mortgage rates, but a large chunk of it is. The last thing is the total inventory is up 23.5%. 63%, which is a big number. This is a really healthy sign because the reason that prices have ballooned dramatically is because there's so little inventory and so much demand. That seems to be changing and leveling out slowly but surely, but we won't know until the end of the winter and as we move into the spring. Part number 3 is the new construction sales market, and if you thought a 30% increase in inventory was a big deal, then this is even bigger. 63% more new homes that you could purchase in Kansas City right now than this time last year. 63%. More than double the amount of inventory in the new construction homes market. And this is for 2 reasons. One is supply chain and labor. All of those issues have gotten better, but they're still not perfect. It would still take months to get windows and appliances and all the big parts in. Wood has decreased in cost, which is a big plus for home builders and new construction home buyers. The second is that mortgage rates were really, really low when these builders were planning all of these projects that they were going to build. A lot of them are operating in master plan communities, and not just one, but they're operating in several throughout the Kansas City area. So when they take out their loans to finance these construction projects way back when rates were really, really low, and they're most likely getting a better rate because they've got a relationship with these banks and the banks know that they're going to be paid back, the cheap money that they could use to build all of these projects was a huge reason why they increased their inventory by so much. Now that 63% increase in inventory might seem like a really good thing, right? The whole problem here is that there's not enough homes in the Kansas City area to buy, and that's why prices are increasing. Well, when that increase in inventory is met with a decrease in demand, a decrease in closed sales like we saw this year of 10.9% and last year of 12%, it can create a big problem for builders. But it can also create a golden opportunity if you are in the market to buy a new construction home. Maybe you missed out over the last couple years, but that might just be the best thing that could have happened to you because now you're in a position to get a really good deal. And the reason is because of how builders make their money. They can take a loss on one home, but they borrowed all this money over the last few years when it was cheap, and they built a bunch of homes since then. Now they've got to clear more than just one home, which means they're going to offer discounts, and there's going to be some room to negotiate some upgrades that would have cost an arm and a leg just this past summer. So for access to those, find my contact info in the description. I'd be happy to make sure we not only secure you a big credit from the builders, but also negotiate for the best upgrades at the lowest cost. Now, as we get close to the end of 2022, we'll have a really good idea of what's going to happen in 2023. So stay tuned, hit that subscribe button so you see the market update next week, and I'll see you then.